I think emerging markets, in the currency markets especially, everything's been tarnished with the same brush, and I think that's unjustified. There are certainly valuations within different currencies which are certainly much more compelling. I think certainly on the current account surplus side, Singapore still looks okay, Korea won looks okay, but everything's being lumped into the same basket at the moment. I think there are still big risks around owning emerging market currencies, so I wouldn't be looking to buy right now myself. I think there is potential modest upside in certain currencies over the next 6 to 12 months. But right now, I think we are delicately poised in a number of asset classes. Sentiment is very, very poor. And, you can be a contrarian. I don't like to be a contrarian personally when I'm trading. I like to follow the money. I like to follow the trend. And we're just not quite there yet in those currencies. So whilst there are some valuation upside emerging in certain emerging market currencies, I just don't think the time is right now to be looking to go overweight that space. I think the markets certainly I think they've looked at the taper side of things and priced that in. What happens now is very much down to the US 10-year. If we do see it markedly spiking back above 3%, that's going to be very interesting, and just see how that goes. I really don't see a massive outflow of, well, we're seeing outflows in emerging markets, but I don't see a really big panic selling coming through from what we've been seeing. I think they've discounted the taper side of things, but therefore, that's why I think the market is going to be repatriating money back to the US. And I really don't think they're going to be looking too much at going overweight that space just yet. So I think they have discounted it, but let's just see what happens with inflation in the US. We do need to see that coming back up a little bit, back up to the Fed's base case of 2% over the next couple of years. But there's some real risks out there right now, and it's just we've got to watch this space and see how it all progresses. Well, we've had a nice pullback in the Japanese market. I think we need to remember it's a very high beta market. I mean, the US, I think, has had, the last time they had a 10% pullback was in May 2012. The Nikkei has had 3 pullbacks of 10% in that time. So we know it can have these big moves, and it had a 57% move last year. I think what's really interesting now is that we are seeing an unwind of the carry trade. I personally like buying dollar yen on moves below that 101 pivot, and I think the market seems to be responding to that quite nicely over the last couple of days as well. The thing that concerns me at the moment is that we are seeing inflation expectations moving up quite nicely. If you look at break-evens over the next 5 years, it's expected to average 2%, which is great. It's what Abenomics is about. But we're not seeing that wage pressure coming through yet. We're not seeing the wage upside. In fact, we're seeing actually negative real wages for the second year running in Japan, which is never a great combination. But it does take time to create real wage growth, and they're under a period at the moment where they're trying to do these wage negotiations. So we need to see more of that coming through. I actually sit in the camp that I'm pretty neutral on Japanese equities right now, just because of the negative sentiment towards what's going on. We see corporate earnings are doing okay. But I think for me, given that I'm a trend trader, I want to wait till the equity market starts picking back up again and actually starts heading higher. And then I'll probably join that trend and actually look to jump on, because at the moment, my gut instinct tells me this is a buying opportunity, but it could get a lot uglier. And that for me is why I'm sitting on the sidelines with Japanese equities and dollar yen right now.